Thank you, Peter, for the introduction, and thank you to the conference organizers for including our my paper in the conference. It's a pleasure. I'm Eddie Watts. I'm an assistant faculty member at Yale School of Management, and I'm going to be presenting today a short presentation on my co-authored paper, ESG Ratings: A Compass Without Direction, which is co-authored work with Dave Larker and Brian Tayen at Stanford GSB, and Lukasz Pomarowski, who's at Arcadian Asset Management currently. And so sort of at a high level, what we're doing in the paper is really giving an introduction on kind of what ESG ratings are and some of the considerations that are actually out there, and really just trying to address a lot of the confusion that's actually in the space. We go through a little bit more in the paper, but sort of the bigger things that I'll talk about here in this presentation for sake of time is sort of a high level overview of who demands ESG ratings and why. What are they actually supposed to measure and what do they measure, or kind of how effective are they? And then talk a little bit about some structural aspects in the industry to consider that might actually influence ratings, and sort of a higher level overview or just posit some questions on why we should actually care about this. Really kind of most presentations here, I suspect, have some sort of plot showing ESG investing has grown over time, and most people probably recognize this. A lot of people probably show the UNPRI signatories or kind of assets under management, but ESG has been growing in popularity across the globe, kind of amongst the investing and also non-investing public. And just kind of a simple experiment on this is looking at the Google search intensity of ESG investing. We can see it's increased substantially over the last 20 years. It's flattened out a little bit. Or rather the last decade, it's flattened out a little bit recently with some of the ESG pushback, but also just the market becoming more sophisticated. And obviously with increased interest in ESG investing, it's important to ask where investors are actually getting this information. And it turns out corporate ESG ratings are sort of the primary resource that most people use. This is from Sustainability's Rate the Raters survey, where they survey a number of institutional investors, and kind of tied for number one of in-house research for kind of the most common source of ESG data is going to be corporate ESG ratings. And as you might expect, once you start to go to less sophisticated investors, this number is probably significantly higher. And an important consideration is simply why are investors actually care about ESG? Because it's going to dictate kind of, or it doesn't necessarily agree with what ESG ratings actually capture. And a lot of investors are using this for better risk-adjusted investment performance, for instance, mitigating downside risk or identifying attractive investment opportunities. But a lot in kind of some of the traditional socially responsible investors want to avoid social harm. It's more ethical not to invest in tobacco companies or high-polluting companies, or they're trying to have impact on companies, kind of using investments to change the world. And I note this because, as we'll see, there's been a lot of disagreements and a lot of confusion in the space on a lot of confusion in the space on kind of what ESG ratings are actually designed to capture, because it's not all three, and sometimes they can disagree. And just by way of this is a number of years, or a couple of years ago, when we actually wrote this paper, largely in response to some of these news articles. But there was a kind of growing sentiment that ESG ratings weren't actually capturing what the investing public actually thought it was. And so you can see this Bloomberg article, the ESG Mirage, where they note MSCI, the largest ESG rating company, doesn't actually measure the impact of the corporation on the world, but whether the world might mess with the bottom line. And if you read the article, MSCI in the article, but more generally with their methodology, is very clear that on what they do. They sell this data, or they sell these ratings to investors, and they market it to kind of what investors are looking for. And if you look at the MSCI methodology, MSCI ratings aim to measure a company's management of financially relevant ESG risks and opportunities. So it's not necessarily avoiding something like social harm or having impact on corporations, kind of reducing climate risk, but how these things actually affect the bottom line. And so what they effectively do is use a bunch of these inputs and these ESG pillars to figure out what's financially material to actually particular companies or particular industries. And we won't have time to go into it kind of here on how each of these, how this is done in practice. But I'll give you I'll talk a little bit about the confusion that this actually leads to, and kind of some disagreements that this can actually cause. Um, and sure enough, kind of during a similar period, there was a growing pushback. It was kind of highlighting the fact that a lot of these ESG ratings don't seem to agree with each other, kind of growing concerns over what ESG ratings are actually measuring. So Wall Street Journal, is Tesla or ExxonMobil more sustainable? It depends who you ask. Bloomberg, conflicting ESG ratings are confusing sustainable investors. In Financial Times, fund managers struggle to compare ESG apples with oranges. And going back to kind of my previous, and just to kind of highlight this in a very simplistic example, if we take a company like Tesla and we look at the Sustainalytics, FTSE, and MSCI ratings, actually for FTSE, they're the absolute worst in class or worst in industry. And for MSCI, they're the absolute best in industry. And part of this is a reflection of just differences in methodology. Turns out FTSE, in terms of how they actually impute data, they heavily penalize firms that don't disclose a lot, which Tesla tends to do. Whereas for MSCI, they actually impute it from industry and regional norms. Similarly, comparing across, and so very important kind of differences in methodology. Similarly, comparing across something like Tesla and ExxonMobil, it's surprising to most people that, for instance, ExxonMobil rates higher on the E scale, kind of a fossil fuel company versus an electric car company. In most people, kind of the average investor's mind, that might seem strange, but it's important to note that a lot of these ESG ratings actually industry adjust. So all the ratings are basically relative to how you perform or benchmark within your industry. So very, very important. And this just goes to highlight there's significant differences both across ratings methodology, but kind of just highlighting that these are really kind of trying to get at what's financially material rather than necessarily what's most ESG friendly or kind of what would save the world. And kind of another piece of pushback that a lot of the rating agencies have had kind of, and there's mixed evidence in this space that we talk about in the paper, but kind of do these ESG ratings, are they actually helpful in kind of increasing portfolio performance? And just a very simplistic exercise that you can do on MSCI's website, where the MSCI World ESG Leaders Index, which is just kind of a screened index based on the best performers within sector, and versus the MSCI World Index, and if you can't tell the difference or you're having trouble seeing the difference between the lines, it's because they're virtually on top of each other, kind of just highlighting kind of whether there is actually ESG alpha here. And this has been kind of one of the other big pushbacks in the space. What are they actually doing? Are they actually kind of increasing performance? And clearly this is just one simplistic example, but I think it's an easy way to highlight this. And finally, kind of in the last minute, there's a lot of kind of, at least part of the reason why there's a lot of confusion in this space, or I think if you look at it in the lens of kind of the fact that the business model of ESG ratings, a lot of what we actually observe makes a tremendous amount of sense. So kind of the IO of ESG ratings is there are many, many different ESG ratings out there, and there's been some kind of consolidation throughout the years, but there's a lot of them. So And what they do is they market themselves to investors. So is it necessarily surprising, for instance, that we find significant disagreements in ESG ratings? The average correlation across kind of ESG ratings might only be, or kind of pairwise correlation is really just something like 54% for kind of the high level ESG rating. And maybe it's not so surprising in the sense that there could be significant disagreement kind of in terms of like what's actually financially or kind of financially important for particular companies. But if you're an ESG rating company and you're doing the exact same thing as the other ESG rating companies, there's really only need for one of them, right? So kind of it's very, very natural to expect this probably, or kind of expect these low correlations if they're sort of marketing themselves and trying to argue that their methodology is kind of the best. Similarly, when it comes to kind of the incentives of ESG ratings, they sell to investors. Investors kind of want performance. So if you actually look at kind of thinking about how financial incentives might actually influence ratings is really, really important. Because, for instance, and this is a very simplistic example, if you look at kind of the performance of ESG indices based on ESG ratings, kind of pre-launch versus post-launch, they seem to do much better pre-launch. And kind of there's there's real questions in kind of the financial incentives and what, you know, and it's something to keep in mind for investors or anybody actually using these ESG ratings, that they're sort of designed to look the best performing possible, and kind of questioning. And some of these companies do things like backfill their ratings or kind of improve their methodologies over time, which might not necessarily be what the investors are actually being able to use. And so kind of with all of this, and ESG ratings are undoubtedly important and useful, right? There's issues with them. But there's kind of questions out there on why this matters. And just a couple of questions we pose here or pose in the paper are things like, are institutional fund managers properly motivated to ensure ESG ratings are reliable? Maybe they just use it as a check the box exercise, right? And on top of it, do retail investors really understand what ESG ratings are? Going back to the Bloomberg article I kind of mentioned before, there's recognition that most retail investors probably don't fully understand what these caps are. And if they don't, they maybe don't understand kind of what the ESG rating of the funds they're investing in or capturing. And then most important, kind of, should ESG rating agencies be regulated? Actually, this has already happened earlier this year in the EU. I don't think there's any plans in the US, but kind of given the number of assets that are actually tracking these ESG ratings now, and the lack of transparency around things like methodology and stuff, these are kind of bigger questions that are being highlighted in the investing community. So with that, I just want to thank the conference organizers. Again, I want to thank all of you for watching the video and allowing me to present. And I hope you like the paper. Thanks so much.